Hey everyone, welcome back to the channel. Today we are diving into something truly amazing. I cannot wait to share it with you. Make sure to hit that subscribe button.
In this video, we are going to see about if you
It's not a game. It's a rich thing.
For the past 2 years, artificial intelligence has existed primarily as a speculative capital expenditure. The 2025 earnings reports from the top 50 global corporations mark the definitive end of the speculation phase and the beginning of realized structural revenue generation. This visualization tracks the historic top line growth seen across the tech sector in early 2025. On the left, the compounding capital expenditure flowing into global AI infrastructure. On the right, the Q1 through Q3 corporate earnings figures that are now justifying the spend. Google Cloud revenue accelerated, posting growth between 28% and 34%. Simultaneously, Amazon Web Services has scaled its AI operation to hit a 132 billion annual run rate. Growth now extends beyond pure compute infrastructure. IBM's generative AI book of business expanded rapidly, pushing past 9.5 billion in the third quarter alone. The scale of these numbers forces a direct analytical question. Is this historic revenue surge sustainable, or is the market in an infrastructure bubble? To understand the sustainability of these financials, we must reconstruct the AI value chain from the bottom up. We will map physical constraints to software margin across four layers: fabrication, hardware, cloud, and enterprises applications. Understanding the future of enterprises software revenue requires an absolute understanding of atomic level physical semiconductor constraints. The lowest level of the tech stack, the physical bedrock of the entire system, is 2nm fabrication. Commercial mass production at this scale is now active. Samsung has officially initiated a mass production of its first generation 2nm gate all around technology. This image captures the physical reality of the process. TSMC is operating on a parallel timeline, preparing their N2 node for mass production in late 2025 and project exponentially high production yields. In semiconductor manufacturing, the critical yearly indicator of market readiness in the tape out, the final phase of the design process before a chip is sending for manufacturing. TSMC is reporting that their yearly tapes out for the 2nm node are vastly exceeding the volume they saw during previous cycle for both 3nm and 5nm chips. However, having this physical bottleneck concentrated in Taiwan presents a significant geopolitical vulnerability for the global supply chain. This map visualizes TSMC's direct response to that risk. They are reallocating approximately 30% of their 2nm and advanced node production capacity across the Pacific to new facilities in Arizona. This de-risking strategy is proceeding despite US export controls affecting specific market like China. Global demands for an AI infrastructure remains robust enough to absorb the entirety of this new capacity. TSMC maintains that its global demand ensures their long-term growth targets will be met. The entire multi-trillion-dollar digital AI economy is strictly gated by this specific microscope fabrication yields and their geographical relocation over the 24 months. Moving up to second layer of the tech stack, we reach the hardware and AI accelerators. These are the components directly fed by the 2nm silicon. As raw silicon is packaged into functional hardware, NVIDIA maintains its dominant position. The data center revenue recovered massive quarter-over-quarter growth, expanding between 56% and 73%. This growth aligns with TSMC's revised 2025 projections. AI accelerator demand is doubling, pushing their compound annual growth rate well past previous estimates. This concentrated hardware layer acts as the engine for the third layer of the stack, good infrastructure services. This chart breaks down top line revenue growth across the major cloud providers Starting with Google Cloud, we see the growth accelerating between 28% and 34%, driven by a AI computing demand. Microsoft Azure mirrors this trend. The integration and adoption of AI services have significantly buoyed their overall service expansion, and Amazon AWS has reached a financial milestone pushing to 132 billion annual run rate, fueled by this same demand. This is a synchronized global macro trend. Looking at the Asian market, Alibaba Cloud has reported 9 consecutive quarters of triple-digit growth, significantly in their AI-related products. The financial mechanism is clear: massive one-time capital expenditures in fabrications and hardware layers are successfully materializing as recurring service revenue in the cloud layer. Cloud infrastructure is the essential transmission mechanism. It converts raw physical power into a accessible, monetizable corporate utility. We have now reached the apex of the value chain, layer 4, enterprise application and consulting. This is common market misconception that hardware manufacturers like NVIDIA and TSMC are the only high-margined beneficiaries of the AI boom. The 2025 data tells the different story. IBM serves as the definitive case study for explosive software margin expansion. This dashboard tracks IBM's generative AI book of business. In the second quarter of 2025, it sat at 7.5 billion by the third quarter. It surged past 9.5 billion when we isolate the consulting sector within those figures. The divisions alone drove 1.5 billion in third quarter generative AI business. These figures carry heavy weight. AI now accounts for 12% of IBM's total revenue, 30% of their new signings, and 22% of their entire backlog. The critical metric, however, is profitability. IBM reports that its AI business currently operates within a 3-point margin differential. This differential proves that AI consulting is significantly more profit per dollar than legacy IT services. IBM is not an outlier. Oracle has reported a massive expansion in their remaining performance obligations, fueled by contracts with OpenAI. SAP reports that over 50% of all new cloud orders are strictly AI-based applications. Digital advising has seen a parallel impact on efficiency. Meta and Tencent both realized ad revenue boost of roughly 20%, with Meta's AI ad tools hitting $60 billion run rate. The historic margin expansion realized at the enterprise's software layer serves as the ultimate financial validation of the AI supercycle. Reviewing the constructed model reveals a systematical financial loop. Massive capital investment pours downward into the foundation layers of fabrication and hardware. In return, high margin revenue flows continuously upward, starting at cloud services and expanding the enterprises level. The 2025 earnings season proves that capital expenditure at the semiconductor level is successfully converting into high margin revenue. However, this entire multi-trillion superstructure remains highly precarious. This software prosperity relies entirely on the successful scaling of the TSMC and Samsung's 2nm production yields. Tracking 30% supply chain shift to Arizona will be at geopolitical imperative of the next 24 months. To predict a software market correction, an analyst must carefully monitor microscopic bottlenecks of raw silicon fabrications. In the measure AI autonomy, software economics and enterprises margin are permanently tethered to the law of atomic physics. If you like the video, hit the bell icon and share with your friends and family, and subscribe for more videos. Hit the bell icon to get notified.